What's up, everyone? I'm back with Option Edge, and today we're looking at FIVN. Okay, FIVN is an interesting stock. It's a very good stock. I invest in this company with just common stock buying and holding for just because it's a good business, and you want to invest in good businesses that will continue to do well, and you'll have a good return on your money. But for options, that's a different story. So today, as you can see, FIVN crossed down through its 200-day moving average. Okay, so that's a significant. That's pretty significant because algorithms like to trade based off moving averages. So if we also track the moving averages, we can trade like algorithms, which sounds cool. Using my back tester, I tested what happens when we go through the 200-day moving average and when we're already below the 10-day moving average, which we are, and what would happen if you were to sell a put credit spread underneath that. Okay, so with a 14-day expiration and with a out at 50% loss, out at 50% gain, this is what the back tester shows us. If this could scroll up, that would be great. Okay, so you can see 89.1%, average return 20.9%, 0 losses. And so then let's go back to the chart. Normally I'd be worried about when stocks go through their 200-day moving average. That's technically a bearish signal, but we have good resistance here at the 154 mark. And you can see today that the stock actually touched, you can see the wick, it touched that mark, but then came back up. So to me, I said, all right, we got a little bounce off of support here. So my game plan is if we were to close below 150, this other support line, that we would get out of it. Besides the that 50% mark as well, the 50% loss that I showed you in the back tester. So let's go to the options. So we're looking at, if we go back to the back tester, I like, just because we had the highest return, I like to sell the 60 delta puts and then buy behind it the 40 delta puts. Okay, let's go to Robinhood. Robinhood actually now has this nice visualization piece that goes along with your trades that on the desktop, not on the phone, on the mobile. But you can see here, if we take the 60 delta, so we want to sell the 60 delta put, that's going to be at the, let's see what we have here. So the Greeks here, 62 is the delta for the 160 put, and then we're going to buy behind that the 40 delta, and this is 45. So it's close enough. So sold the $160 call and put, and bought behind it the $155 put. So this is what the risk profit loss graph looks like. So the max we can lose per contract is $245, and the max we can make is $255. And something, if you notice something, we can see here is we have more room to get more. There's more reward if we win than there is loss. There's a better risk reward profile in this trade. And one of the reasons why that is the case is because if you sell out of the money, if you sell out of the money puts. So let's do a little thought experiment here. We're going to show you here. Let's get out of this. We want to get out of this. So if we were to sell something that's out of the money, okay, let's say the $140, okay, if this would let me click on it, that'd be cool. All right, we got this. Let's click on this. All right, and let's buy the 135. Okay, so before we're selling the 160, buying the 155, and now we went out of the money to $140, the $140 strike and the $135 strike. So the probability that 5.9 stays above the $140 strike is higher than the probability of 5.9 to go up above the $160 strike, like in our last trade example. So let's look at the profile graph here. As you can see, we can win $35 max, but we can lose so much more here, $465. So that just shows you, that's just a little example of showing you how the risk reward changes as you go farther into the money and out of the money. So now let's do another example. So this is the trade I took, the $160 and the $155 puts. But let's say here's a high probability trade that won't happen. In 2 weeks, because this is June 18th, we will most likely not be above $200. Okay, but let me show you what the risk reward is on this. Okay, so make $485, and the max we could lose here is $15. That's actually, I'm not even sure if that's correct, but as you can see that the risk reward here as you go farther up goes in your favor, but it's much less likely to happen. So that's what we're doing with 5.9. I'll let you know how this trade works out. So yeah, hit me up if you're interested in talking about options. Peace out. Bye.